So today's video, I actually want to make my case for housing. There's a lot of negative news out there. A lot of people have been down on housing. And I just think it's time for somebody to kind of come out there and lay out some information that will help you actually understand what's going on in housing, at least from my perspective. Those who have been negative on housing have been negative on housing for over 5 years. And they've been wrong for 5 years. So I really want to go through here and I want to talk about some of the key concerns that I think buyers have when looking at the housing market. Like what's going on with interest rates? What's going to happen with housing values? Is there going to be a crash? What about affordability? And what about the talk of a recession? So these are all things I'm going to address in this video. It's going to be a little long. I'm going to slow my roll on how fast I talk because usually my videos, I try to keep things short. But I really think it's important that we take the time to dig into this so you guys make a good informed decision. If you disagree with me, please put your comments in the down below. I'm happy with naysayers. Let me know what information you're looking at that I might be overlooking that might make a stronger case that says that the market's going to crash. So let's go ahead and just dive in. I want to start some recent headlines that just come across my desk there as things get emailed in. So first one is Goldman Sachs sent out a note to clients basically stating that they actually believe that interest rates are going to be about 6.5%. So they're going to stay high throughout 2023. And this is something that I'll disagree with, and I'll show you my information on that. Also, this is a video I just did not too long ago. This is right now is about the middle of February. But I did a video on a recent survey that was done by NerdWallet, where according to those they interviewed, 67% of Americans expect a housing market crash is imminent within the next 3 years. Now, my biggest beef with this article was that it's very misleading headlines, but this is what you guys are getting all the time. 67% of Americans would lead you to think they interviewed all Americans. So without knowing how big of a pool of people they interviewed, what were their demographics? Where were they living? Are these the cities that saw the highest increase in values or the lowest? I mean, without this stuff, I don't know. Also, the whole idea of imminent in 3 years to me is an oxymoron. I think imminent's like right now. It's imminent. So to say that housing market crash is imminent in the next 3 years, well, what happens if housing values go up the next 5% per year for the next 2 years and they have a correction of like 10%? Did you really win by waiting the 3 years? So again, very misleading. We'll talk about that. Another one here is Moody's forecasts talking about values. I know a lot of people are thinking about housing crash. And I totally disagree. I'm going to give you good information, at least I think it's good, as to why you shouldn't be buying into this hype. But they actually think Moody's forecasted that we're going to see about a 10% drop in 2023. And that would be just right on the edge of a crash. I mean, to call it a crash, you need to see more than a 10% drop in values. And so that would just, even if it was, be right on the edge of barely being called a crash. So why is it that I disagree with this stuff? Well, let's go ahead and just jump into interest rates. I think interest rates will go lower in this year. I actually think we'll see interest rates probably by summertime in low fives. By the end of the year, 2024, I think we might see them back into the high fours. Now, whether or not you should wait for those rates to buy, check out my other video that's going to be on the cost of waiting. It's not a good idea to wait for those lower rates because you're going to actually not win because the home prices will go up as those rates come down and you're going to lose on that. So check that out. But let's take a look here. So this pink line just shows you the rate of inflation. Inflation is so key. All of last year, the smart money knew that interest rates were going to have issues until we got through October of last year, because it wasn't going to be until October that we saw inflation coming down. All kinds of reasons for that, but basically it's a rolling 12-month cycle. And we believed that what the feds were doing were going to have an effect, but you wouldn't get that effect or feel it into your reports until after October. And sure enough, that's what happened. What you see here is interest rates coming down, and it makes sense if you have really low inflation that you see low rates. But then we saw inflation skyrocket. It just took off. Not partly, because the feds continue. This here white line shows this is the feds doing what's called quantitative easing. They were actually going out buying billions of dollars of mortgages, so creating massive amount of demand, which drove rates down, because as long as they're willing to buy it at 3% or 2.5%, the market created the supply for that. And even though inflation started going up, you should have saw rates go up, but it didn't because of this artificial manipulation of rates in the market. Now, why were the Feds doing that in 2021 when home values were already going way high from 2020? You didn't have enough inventory to meet demand. I have no idea why the Feds started to do that, but they did it. Here you can see when the Feds stopped, they finally realized, we've overcorrected. This isn't good. And now inflation's out of control. And you saw rates respond as the market moved back in to be the main player. Nobody in the market with their own money wanted to buy an interest rate at 3% when inflation's running at 6, almost 7. But sure enough, you get to October and look, you see that you have inflation rolling over, or this is interest rates that actually finally passed inflation. So now you're actually making money. But then you saw inflation coming down, and look at that, rates have responded. So my argument for interest rates going forward in 2023 is that we will see that go down because we're going to see inflation come down. And as inflation comes down, rates will benefit from that. I also think we'll see a prolonged one because I do think there's a recession coming. We'll talk about that here in just a few moments here. But as the recession comes, that gives further reduction in inflation. And at some point, the Feds will reverse engines and will stimulate the economy to get it out of a recession. And when that happens, I think you see rates go again. So I believe that we actually have already seen interest rates put in the high. In fact, Zillow and a company, so Zillow teams up with Pulsenomics, where they do a survey of the 150 top economists in the United States and get their view on what they think is going to go on. And according to the top 150, they actually believe that interest rates put in their peak already this year, and they think that rates will go lower over the next 2 years. So they think the peak, like me, peak has already been called in. Home values, they actually think that over the next 5 years, home values will go up about 23% over the next 5 years, which is on average, that's a little over 4% per year, which is normal and healthy home appreciation, which a lot of wealth can be created. So again, this isn't just me. The top 150 economists in the United States actually believes this information as well. I'm just going to try to explain some of that to you. But inflation, key driver. Okay, so what about the housing crash? So these naysayers, they've been here for over 5 years, and at some point they will be right. I'm not an eternal optimist to say that there'll never be a housing market crash. Housing is cycles. There'll be cycles. But I'm going to actually look to good data to determine as best I can what will happen. Now, there's always these anomalies that happen, and COVID is a perfect example of how it can be a disruptor to the market, just happened to be a positive disruptor for housing. But the fact of the matter is all this time they've been negative on housing. And 2016 was a really, really hot market. If you guys remember that, it was really good at home appreciation, rates had come down. But look at, if you own a house in the last 10 years, 115% appreciation. That's like over, I think on a $500,000 home, that works up to being like $115,000 of equity over that time frame. It's a ton. Then you look at the last 2 years, you see about 39% just the last 2 years. And during this last 2 years, they were negative in 2020 in housing. They were negative in 2021 in housing. And if you listen to them, which I feel bad for the clients of mine who kept thinking it just can't keep going, I'm going to wait, they missed out. And now housing has leveled off and pulled back, but only 2.5%. I hardly call this a crash. And I believe that because of inflation's already coming down and we're already seeing rates come down, that this is going to be a short-term pullback, and that by summertime, we're going to see homes values actually go up year over year. I actually think by the end of the year, we'll see home values up near 5% nationwide, 4 to 5%. So again, the naysayers here unfortunately missed out because now they're paying 40% more for the house, and they not only are they paying 40% more for the house, they gave up some of the all-time lows on interest rates, buying homes in around the 3 to 2.5% range. So big loss for those who listen to the naysayers in those years. So here's one of the charts that the naysayers were using, and I'm seeing it today. So if you go back to my videos, you might see this chart here. I've talked about this several times, but all through 2022, what we heard from the naysayers was that housing market crashed. Homes simply are not affordable with so much appreciation in the last 2 years, and interest rates on the rise. House is going to crash. Okay, this is the news. This is what they're citing, and as proof of that, just look to inventory. Inventory was rising, and that's a sign that the housing market is cooling, and therefore they got people to be afraid and back out of the market. Now, in my videos, what I talked about is how they're failing to show you the full picture. So let's take a look at a longer chart. So this goes back to 2016. And again, 2016 was a great year in housing. And what they failed to explain was that what they were talking about as supporting the reason for negative housing is actually a normal cyclical cycle in housing. There's buy periods and there's sell periods. In the high, summer times, people are ready to move. You start to see inventory sell off, just like we're seeing right now. But then as you get school starts up again, you start to see fewer buyers want to make moving, and so inventory kind of moves up a little bit, and you stack up until you sell. What they're now saying is, okay, not only they're not kind of using the whole because it's rising, because actually now it's coming down, but they're saying inventory is almost twice what it was last year. Bad market, housing crash is coming, double the inventory. But again, please look at this chart. I mean, what does this show you? Normal inventory is up more like 1.2 to 1.4 million units. Even with double, we're doubling off abysmally low numbers. So again, doubling one isn't the same as doubling 100. And we really do not have enough inventory. And we're already going into this natural rollover where we're starting to see a sell-off. So we have lower lows. We got a higher high because interest rates shot up. Yes, that had an impact for sure. But is that sustainable? Is that going to happen? And how long is it going to take us to get back up to a healthy market? So this just shows you the supply side. There simply is not enough supply in the market when you look at historically where we should be. And again, while we might be double where we were last year, it's certainly half of where it should be, and we're already going into the next selling cycle. Here's what a housing bubble looks like. So this chart here shows you inventory in the dark blue, and this is U.S. population. Now this only goes out to 2021, but as you saw in the chart just before, in 2022 and today, there's even less inventory than what we had at the beginning of 21. So what this shows you is this here was a bubble because we had way more housing supply in the market than we had underlying fundamental demand for. Yet, in spite of that, we saw record appreciation, not record compared to the last few years, but we saw appreciation into the double digits. And so that happened because with all the loose lending rules we had back then, people could state their income. People who couldn't really afford one home were buying 3 and 4 homes, trying to flip them and make money. And so people kept buying and selling to each other. And that created this false appreciation of value that we felt. And then when that came crashing down, values plummeted and continued to plummet until all this excess inventory was absorbed. And then again, the banking market kind of loosened up a little bit and people felt comfortable because of all the negative news. In about 2011, we saw a reversal and we started seeing it. But the problem is during that whole time, population kept growing. Builders and stuff stopped building. It was really difficult financing to build. And now when the builders stepped back in, there weren't as many builders to be able to build, not as much land to build on. And when that demand came back to the market, they just could never catch up. I think this is the same issue we have right now. Interest rates shot up. Builders learned their lesson from 2007. They didn't want to be holding a bunch of properties as this market was going through a temporary reset. So they slowed down or stopped and delayed housing expansion projects. And now when the market comes back, as rates come back down, they get this magic number where people start to feel comfortable again. The builders, it's going to take them, if the ground's already ready to go, it's 6 to 9 months to build. If they still have to develop the land, you're talking a year or more to actually get development going again. As that happens, population continues to grow, that demand comes back into the market, and there's going to be a big issue. So I think what we have here is we have what I call a shadow or demand. Everybody who wanted to buy a house in 2020, 2021 who couldn't, only actually 30% of people who wanted to buy a home actually were able to buy. So it's like the 70% of these people, it didn't disappear. They still want to own a place. It's called household formation. And my house is a perfect example of that. 2021, I had one house that had 4 people in it. My kids grew up, they moved out, and now 3 houses are being used to house the same 4 people. That requires building to meet that demand. So if there's a bubble here, you'd have to think it was a population bubble, in my opinion. And I don't think we're going to see that. And again, I think as market normality, so rates just stop going up so fast, will help some people come back in. And then as rates come back down, that will start to pick up momentum. And those who wait for that real low one, you're going to be back in the situation with multiple offers, not being able to drive as good of a deal as you could now. And I think you're going to end up overpaying because, again, of fear and missing what's a good opportunity. Now, I think we have continued pressure on housing because household formation, as I just mentioned, if you look here, here's the birth rate since the 70s. You'll see year after year after year, there's more higher and higher birth rates, which means we should see more and more household formations coming to market year after year until we get to about 2027. And then we'll see a bit of a reprieve. Now, it's not going negative. It's still very, very high birth rates, but it's a little bit less, and that helps a little bit. But this is going to add additional issues in the supply and demand equation. And while you're getting a nice little reprieve right now because rates went higher, people are fearful. This is actually a good buying opportunity because sellers are willing to negotiate. If you wait to be happy like everybody else, you're going to lose that opportunity. So let's talk about the housing recession, because I did say I think there's a housing recession. And actually, what you'll see here, the dark lines show you recessions, and this shows you the Case-Shiller pricing index. So that's kind of gold standard for home appreciation. And you'll see that in all these recessions, with the exception of two, in the 60s, we saw a little bit of a prolonged stagnation in the market, real long period. But since then, in the 70s, we've seen in recessions, the home values actually increase during the recession and pick up a little speed coming out of recession. And so we don't really see that case, that argument that there's going to be a discount because of recession. I'm sorry, you don't see that with the exception of 2006, which we've already talked about. That's not a normal recession. That was a real estate-led recession where you had an oversupply of housing compared to actually underlying demand. And yes, in that situation, you would expect to see a nice pull down in values. I don't see that today. I see that we don't have enough under supply for the demand. And so while I don't think you're going to see home values continue to go up, what we saw in 2021, brought on by, again, Feds driving rates lower than they would otherwise be, I do think, I agree that you will probably see housing values over the next 5 years be normal, which normal is 3.5% to 5%. As I said, the 150 economists that just got surveyed, they think it's going to be around 23, so just under 5% per year. And I agree. I think that's kind of where it's at. And I think this year we'll probably see 5% increase. I think 24 might be a little bit hotter than that, but I think it's fair to say that over a 5-year average, we'll revert to the mean, which would be more like that. So let's talk about affordability, because everybody else says, hey, that's great. Yeah, I mean, maybe the market doesn't have enough supply and demand there, but homes just aren't affordable. So even though there's this underlying demand, if people can't afford it, they just won't buy. And this is really important because, again, another one of these things where the headlines, the news, and the naysayers, they pick and choose what they're using to support their negative bias on housing. And I want to give you the full picture, and hopefully you can make a more informed decision. Now, first off, I just want to talk about affordability. It's an individual thing. So to sit there and say homes aren't affordable, on what basis are they saying this? A person who makes $1 million a year, buying a house for $500,000, it's affordable. For a person who's not making very much money, housing may never have been affordable or never was affordable. So the definition, I would say, for affordability for the individual is if your housing cost, whether you own or you rent, is less than 30% of your income, it's affordable. The more below that, the more affordable housing is to your income. The more you spend in 30%, the less it's affordable to your income. So that's an important thing. Now, the reason I want to point that out is in 2020 and 21, when we saw housing values skyrocketing, the whole time the news was saying this isn't going to last, housing correction, because homes aren't affordable due to price. They were ignoring that during the same time rates went from 4% or 4.5% down to 2.5%. And actually affordability beginning in 2021 was way more affordable than it had been in the past. And more Americans could actually afford homes then. So those who bought into that hype and didn't buy because it wasn't affordable and home prices come down, I know you guys are kicking yourself in the butt, and I'm sorry for that, but that time has passed. So what we want to look for is the future. After home values started to stabilize, now, of course, the huge reason why homes aren't affordable, it's because of rates. And so what I want to do is show you kind of the whole picture of what affordability looks at. So let's just say beginning of 2022, a person bought a house at 4%. Rates are already come off the bottom. They got a 3.5% rate instead of 2.5% rate, but they finally pulled the trigger. And here's their principal and interest. We'll just say this is the loan amount. and we won't worry about what the price was. We'll focus on just keeping things simple. Now, this year, assuming home values went up about 10%, but rates also almost doubled to 6.25% right about now. That payment now is $2,709. So that's $913 more. Now, this is where they say, okay, look, homes just are not affordable, but they're still not giving you a complete picture. Now, certainly looking at this difference as a percentage, yeah, that's a big deal. And it sure seems like it would not be affordable. But again, they're kind of ignoring an important component of affordability, which has to do with income. Now, if we took a household income, let's say of 9,000, this is good, kind of moderate income here. If we look at ADP, they just did a recent report, and ADP does over 25 million payrolls. So it's a good place to kind of get an idea of what's happening on wages. People who stayed with their current employer saw about a 7.6% rise in their income from 22 to the end of 22. Those who are willing to change jobs actually saw their income go up by over 15%. And on average, we saw a 9% rise. So if we apply that 9% rise to that $9,000, we can look at both sides of this equation. We actually see that from an income standpoint, while it is certainly more, my case is not that homes are as affordable as they were a year ago. My case is it affordable for you? You can see here that it's actually not nearly as bad as what people are being led to think. And it's very natural I understand it's very natural for a consumer to just look at this piece and forget this piece, but you really got to look at both sides of your personal budget to see where things are going. And we also kind of want to look at where things are going to go in the future, because if you don't own, for most people, the single largest monthly expense is rent or their mortgage. So where is that going in the future? And if delaying buying, are you actually setting yourself up for a more affordable situation or a less affordable situation in the future? Okay, so let's just take a look at this. Now, the reality is you do have an additional increase of gasoline, food, and other stuff this year. So not only are you going to pay $913 more for your house payment beginning of this year, but you should expect to pay more for these services. And so out of pocket, you're actually looking at about $1,154. But if we assume just a 5% increase, so about not quite half of what it was last year, your income at the end of the year would be right around $1,300. And so you actually see that your situation has improved here because you've locked in your largest single component of this equation here. You've locked that in, so no more rise there. And your income typically goes up. Now, of course, this might be different for those looking to go into retirement. So let's just say next year, though, I'm right, rates drop. Let's just say instead of happening by middle of summer, it takes to the end of the year. If you refinance at the end of the year, you actually lower the overall cost from $1,154 to $807, yet your income stayed the same, and you've improved your living situation. If you don't own, my argument would be that you're likely going to see rents continue to increase. Now, people talk about rents slowing. Really important, again, because this is another big thing that people kind of twist around and get confused on, is that there's a difference between the rate of acceleration slowing versus going back. So yes, I think the rate of home appreciation in 2023 will not be what it was in 2022, and certainly not what it was in 2021. I just don't think it's going to go backwards. I also don't think that while rents I think are going to start to slow, which will actually help that inflation number, which will drive down interest rates again. I don't think they actually go backwards because, again, underlying supply and demand issues is if I'm not going to buy a house and I still want to get out of the house with my parents or my kids are growing up, whatever the case might be, I got to go somewhere. So I'm going to own or I'm going to rent, and housing supply is tight in both directions. So that's my case for housing. Again, if you have a comment, please let those down below. I have other videos that talk about the benefit or the buy versus rent, because home affordability for most people is, by vast majority of people, the single greatest contributor towards future retirement and financial stability. It's amazing. So if you haven't watched it already, check out a video on the buy versus rent comparisons. I'm going to do an updated one with some updated numbers here as well, but check that out. Also, you can check out a video that I'll be doing on cost of wait analysis, which shows you what does it look like if I wait to buy for lower rates. If I think that home values will continue to go up, I think rates will come down. What's the best way to be able to leverage that to get the best deal? So check that out. Hope you like this. If you did, thumbs up, subscribe, share it to people. More and more consumers, they need to hear this. They really need to hear good, solid reasons as to why the market should do what it is. And headlines are just not worth the time of reading them. So, all right, till next time.